On February 28, 2026, the United States and Israel struck Iran. The world was told this was about preventing a nuclear weapon. Here is the question almost nobody asked. What happens when the world's reserve currency is backed by the largest debtor in human history? At the time, the United States national debt stood at $39.2 trillion, according to the U.S. Treasury and the Joint Economic Committee. It grows by roughly $8 billion a day. The answer begins 50 years earlier. In 1974, Henry Kissinger traveled to Riyadh. The United States and Saudi Arabia forged an arrangement that would reshape global finance. Saudi Arabia would price its oil exclusively in dollars. In return, Washington offered military protection. From that moment, the world needed dollars to buy its most essential commodity. Oil-exporting nations recycled their surplus revenue into U.S. Treasury bonds. This became known as the Petrodollar system. For 50 years, it sustained global demand for the dollar and let Washington finance its deficits cheaper than almost any other nation on Earth. Now the foundation is shifting. According to IMF reserve data, the dollar's share of global foreign exchange reserves has fallen from roughly 72% in 2001 to near 57% today. Saudi Arabia's holdings of U.S. Treasury securities have dropped from $165 billion in 2014 to around $135 billion. Central banks have bought over 1,000 tons of gold a year, 3 years running, more than double the previous decade's average. Then came the Strait of Hormuz. Nearly 20% of the world's oil moves through it. When traffic through the strait was disrupted earlier this year, Asian importers faced immediate supply concerns. After traffic resumed, reports emerged that Iran was exploring alternative settlement methods, including yuan and digital currencies, for certain regional transactions. Every barrel settled outside the dollar is one less transaction reinforcing its dominance. So ask the uncomfortable question: why would a nation carrying nearly $40 trillion in debt commit tens of billions to protect one waterway? The official answer is straightforward. Prevent nuclear proliferation, protect allies, maintain regional security. These are legitimate objectives, and they deserve to be taken seriously. But there is a second, quieter reality. As long as global energy trade runs on dollars, demand for the currency stays strong. If that demand weakens, financing $40 trillion in debt gets more expensive. China's yuan settlement network is still smaller than the dollar system, but every expansion into energy trade is a step toward a more multipolar order. This is not the end of the dollar. It remains dominant. But dominance is not permanence. A financial order built over 5 decades is being tested, not all at once, but one transaction at a time. One tanker. One contract. One payment settled outside the dollar. Follow the money. It often reveals the incentive headlines leave out, and sometimes it tells the story before the missiles do. And that is the harsh truth.